So I want you to imagine something for a second. What if, what if all the elite financial strategies that are usually just totally walled off for millionaires or, billionaires and ultra exclusive family offices, what if all of that could just be digitized, automated, and put right in your pocket?
Yeah, it's a wild thought. Because usually when we talk about high-end wealth management, there's this really heavy expectation of exclusivity.
Oh, totally. You picture like walking into some mahogany paneled office in Manhattan.
Exactly. You sit across from this team of seasoned advisors, guys who charge, I don't know, $500 an hour.
Minimum. Yeah.
Right. And they orchestrate your entire financial life behind these totally closed doors. It's an intimidating environment by design.
It really is.
And that exclusivity, it is historically served as a moat. It keeps top-tier financial strategy gated as this luxury service.
And for the average person, the person just grinding away at a 9 to 5 job, trying to figure out how to build a legacy, that level of service is just entirely out of reach.
Completely inaccessible.
But then you step into the world of artificial intelligence and fintech, and suddenly those heavy mahogany doors are just being blown wide open.
Yeah, they really are.
We are looking at a landscape right now that is fundamentally shifting how wealth is built, how it's managed, and how it's transferred.
Which is honestly the absolute definition of technological democratization meeting high finance. We're seeing the collapse of that traditional barrier to entry. And it's being replaced by just, well, infinite scalability.
Exactly. And that is exactly why we are here today. So welcome to this deep dive. Today, we are exploring an exclusive and, frankly, just a massive stack of strategic business documents, investment presentations, and some highly technical roadmaps.
It's a lot of material to get through.
It really is. But our mission today is to introduce you to the groundbreaking work of Gary Adkins. He is the founder of the IBC Club.
Right, which stands for Investor and Business Consultant Club.
Yep, the Investor and Business Consultant Club. And today actually marks the very first public appearance of his revolutionary creation, which is called the Lulu Real Wealth Executive Application.
It's a genuinely remarkable piece of technology. But I want to set the stage for you listening, because what we're looking at in these documents isn't just, a shiny new tech product.
Right.
From an analytical standpoint, it is a total masterclass in business model transition and what the financial industry calls valuation arbitrage.
Okay, let's unpack this right out of the gate, because Gary Adkins has achieved something really extraordinary here, and it follows a very specific logical structure.
It does. It maps out perfectly.
Yeah, if we look at the core thesis of all these documents, the main idea, using the Minto Pyramid principle, the main idea at the top is this. He has taken a highly successful but completely human-dependent financial consulting practice, and he's transformed it into an infinitely scalable AI-powered software-as-a-service platform.
Which is the dream for any service business, really.
Totally. And Lulu isn't just a chatbot that, spits out generic budget advice. It serves as a personalized executive AI director.
I like that phrasing.
Yeah, it offers that top-tier wealth management and strategy to literally everyone, from the everyday worker to high net worth family offices.
That is the central thesis right there. And supporting that thesis are three massive pillars that we really need to explore today.
Let's hear them.
First, the absolute eradication of the human bottleneck in consulting. Second, the proprietary methodology that actually allows an AI to give safe, highly strategic financial advice without, hallucinating.
Which is a huge problem right now.
A massive problem. And then third, the sheer economic power of delivering this intelligence at a fraction of the traditional cost.
So framing this up, this is genuinely one of the most fascinating business evolutions I have ever seen. But to really understand why Lulu is such a massive leap forward, we have to look at the bottleneck it actually solves.
Right, we have to go back to the beginning.
Exactly. We need to trace Gary Adkins' entrepreneurial journey backward, moving from this final AI product all the way back to his roots in consulting.
Because the documents outline a very clear three-stage evolution of his business.
Yeah, stage one is referred to in the documents as the one-on-one consulting crucible.
The crucible is a very fitting term for it, honestly.
Why is that?
Well, in this initial phase, Gary was doing what almost every expert does when they start out. He was consulting directly with clients, one-on-one.
Just trading time for money.
Exactly.
Yeah.
He had developed this proprietary framework, which he calls the Real Wealth Blueprint. And he was out there proving in the real world that it actually worked.
Right. He was in the trenches.
Totally in the trenches.
Yeah.
Optimizing personal finances, restructuring business credit, and generating empirical hard results for his clients.
And reading the sources, he was just obsessive about documenting everything.
Oh, meticulously.
Yeah, he was recording video sessions, client phone calls, writing down the entire process. It's almost like he was building a manual for a machine that he hadn't even invented yet.
And that rigorous documentation is exactly the bedrock that makes the later AI phase even possible.
Because you can't train an AI on nothing.
Right. You can't train an artificial intelligence on vague ideas or gut feelings.
Yeah.
You need structured, proven data. But while this stage one model is incredibly valuable for proving product market fit.
And generating that initial cash flow to survive.
Yeah, exactly. But from an institutional investment or private equity standpoint, it possesses a fatal flaw.
Okay, what's the flaw?
In the M&A world, mergers and acquisitions, we call it key person risk. Some just call it founder dependency.
So, meaning the founder essentially is the product.
Precisely that.
If Gary isn't in the room, the value just vanishes.
The business is inextricably linked to his physical presence and his personal brain power. Let's think about the reality of that for a second.
Sure.
If Gary wants to take a vacation or if he gets sick, what happens?
The revenue immediately stops.
Exactly. The growth of the entire enterprise is strictly capped by the total number of billable hours he can personally sustain in any given year. It is a linear exchange of time for money, and time is a finite resource.
It's like a Michelin star chef who absolutely insists on cooking every single meal themselves, right?
That's a great analogy.
They refuse to hire a sous chef. So the food is incredible, the customers are thrilled, but you can only serve one table at a time.
Right.
It's a beautiful craft, but it is a terrible business model if your goal is to scale globally.
It captures the frustration perfectly. And because of that inherent bottleneck, buyers and institutional investors heavily discount these types of businesses.
Really? Even if they're profitable?
Oh, especially then. When a founder tries to sell a one-on-one consulting firm, the acquirer knows they aren't really buying an independent standalone asset that generates cash while they sleep.
What are they buying then?
They're essentially just buying a high-paying job. And it comes with a massive amount of operational risk attached.
Ah, because if the founder leaves after the sale, the client trust leaves with them.
Exactly. The trust leaves and the earnings evaporate overnight.
So how does the market actually value a business like that? Like if I have a highly profitable consulting firm, what is it actually worth on paper?
Very poorly, relatively speaking. These service-based businesses are typically valued using a metric called seller's discretionary earnings, or SDE.
Okay, SDE. What exactly is that?
It's essentially the true cash flow of the business that's left over for the owner after all the necessary operating expenses are paid.
Got it.
Historically, because of that extreme operational risk we just discussed, these consulting firms only sell for about 2.0x to 4.0x their SDE.
Wow.
Or, if you look at it from top-line revenue, sometimes it's just 0.6x to 1.0x their annual revenue.
That's incredibly low.
Yeah.
There is a massive impenetrable valuation ceiling there.
There really is.
That has to be incredibly frustrating for a successful founder. I mean, you build this amazing machine, you help all these people, but the financial markets tell you it's basically worthless without you running on the hamster wheel.
It forces you to rethink everything.
Which naturally forces the founder to evolve. And that brings us to what the documents call stage 2, the one-to-many group and digital transition.
Right.
Gary realizes he can't cook every meal himself, so he leverages all those recorded sessions, all those documented frameworks, and he productizes his intellectual property.
A very classic and very necessary pivot for any expert trying to scale.
Yeah, he starts creating courses, ebooks, digital seminars.
This introduces the concept of operational leverage. By digitizing his knowledge into a static product like a course, he can now serve a significantly larger client base simultaneously.
Without needing a proportional increase in his own labor hours.
Exactly. 100 people can buy the course on a Tuesday, and it takes the exact same amount of his time as if one person bought it.
So the gross margins improve dramatically.
Dramatically. And the geographic reach expands way beyond his local network.
But reading through the documents, it seems like there was still a massive catch here. The ceiling he still hit.
Oh, there was a massive catch. While the revenue ceiling was definitely raised, the founder was still fundamentally trapped in the machine.
How so?
He was still tethered to the community he built.
Because of the ongoing maintenance, right? The live Q&As, the group coaching calls, the community management.
Yes, exactly.
The clients bought the digital product, but they still expected Gary's personal charisma and active energy to stay engaged to answer their specific, nuanced questions.
That is the trap of the one-to-many model. The transition to digital products laid the vital foundation. I mean, the intellectual property was now completely documented, structured, and validated by a larger audience. But the business had not yet crossed the threshold into a fully autonomous, investable asset class.
It was still fundamentally service-oriented,
And personality-driven at its core, yes.
which perfectly sets the stage for stage 3, the breakthrough, the autonomous AI SaaS platform, Lulu.
This is the leap.
This is where the story shifts from a typical business coaching journey into deep tech territory. Gary essentially abstracts his own brain into code.
It's an incredible engineering feat.
By feeding all of those documented interactions, all of the proprietary methodologies, the frameworks, the specific financial advice from the first 2 stages, he feeds all of that into an advanced artificial intelligence agent, and he completely removes the human bottleneck.
This is the holy grail of business model evolution.
Right.
Moving to stage 3 represents infinite scalability and the complete definitive eradication of founder dependency.
Because the AI doesn't need Gary.
Exactly. The AI executive director, Lulu, can provide 247 personalized, highly contextual financial guidance to an unlimited number of concurrent users.
100,000 people could log in at once.
And Lulu wouldn't flinch. Lulu doesn't sleep, doesn't need a vacation, and doesn't suffer from cognitive fatigue after the 100th client of the day.
And here is where it gets really interesting, especially for anyone listening who loves the mechanics of business valuation and wealth building. Let's talk about that valuation arbitrage you mentioned earlier.
Yes, the math is fascinating here.
Because the documents point out a staggering shift in the financial math once this transition to AI occurs. By moving to a software as a service, a SaaS model, with a zero marginal cost of replication, the valuation metric fundamentally changes.
It does.
But I need you to explain this to me like I'm 5. Why is the math changed so drastically just because the delivery method is a machine instead of a man?
It changes because the investment market shifts its perspective. They go from looking backward to looking forward.
Okay, what does that mean?
Well, traditional consulting, as we discussed, is valued on historical sellers' discretionary earnings. You are paying for what the founder did last year, hoping they can do it again next year.
Right, hoping the past predicts the future.
Exactly. SaaS, however, is valued on forward-looking annual recurring revenue, or ARR. The subscription software model gives institutional investors deep, predictable visibility into future cash flows. When a customer subscribes to an app for a year, the investor knows exactly how much money is coming in.
And they know the software won't suddenly quit to start a rival firm.
Right. The risk is vastly lower.
So let's break down the numbers on this because seeing this math in the documents genuinely blew my mind. Let's set up a hypothetical. Say you have a traditional financial consulting firm generating $1 million in annual revenue.
Okay.
And let's say it has a 30% profit margin. That gives you $300,000 in SDE.
Right. And using that standard consulting multiple we discussed earlier, let's be generous and say 3.0x SDE, that entire enterprise is only valued at roughly $900,000.
Wait, so the entire business is worth less than its annual revenue?
Yes, exactly.
Okay, hold that $900,000 figure in your head. Now, take that exact same $1 million in revenue, but transition it into highly predictable, software-driven annual recurring revenue via a platform like Lulu.
The math just explodes.
How much?
A high-growth, scalable SaaS platform generating $1 million in ARR, completely unburdened by key person risk, and boasting the massive 85% gross margins that Lulu is currently projecting.
Yeah.
That business is evaluated entirely differently. In the venture capital market, a SaaS company with those metrics commands a revenue multiple of roughly 10x to 12x.
So that $1 million in ARR equals a $10 to $12 million enterprise valuation.
Exactly. Gary engineered a 13x to 15x expansion in the enterprise value of his life's work simply by changing the delivery mechanism.
That is wild. He didn't even change the core product.
He didn't change the core financial advice. He didn't change the underlying methodology.
Yep.
He just operationalized his intellectual property through artificial intelligence. And in doing so, he met the exact criteria that institutional capital demands.
Right.
Highly predictable recurring revenue, near zero marginal cost to deliver the service to the next customer, and total founder independence.
That is just a brilliant strategic pivot. It's taking a great practice and turning it into an undeniable asset.
It really is.
But it raises a massive glaring question for me. I understand the business math, but Gary abstracted his brain into code.
Wow.
He built this AI.
Right.
How does an AI actually execute the highly nuanced, deeply complex job of a high-end wealth manager? I mean, we've all used AI chatbots.
Sure.
Sometimes they're brilliant, and sometimes they confidently tell you that 2 plus 2 is 5.
Or they invent a court case that doesn't exist.
Exactly. How does Lulu avoid hallucinating, or worse, just giving out generic, useless financial advice like, buy less coffee and save more?
That concern is exactly what venture capitalists look for, and it points to the critical technological and methodological moat of the Lulu application.
Okay, what's a moat in this context?
A moat is just what protects the business from competitors. It brings us to the core engine, the proprietary real wealth methodology, because in the mature investment landscape of 2025 and 2026, venture capitalists and private equity firms have become incredibly adept at spotting and rejecting what they derisively call AI wrappers.
Wait, define an AI wrapper for me. Are we just talking about an app that acts as a middleman?
In essence, yes. An AI wrapper is an application that has a nice user interface, but under the hood, it simply takes your prompt, sends it directly to OpenAI's ChatGPT or Anthropic's Claude, and spits the generic answer back out to you.
Just in a slightly different font.
Exactly. It has no proprietary knowledge. It's just a thin skin over someone else's intelligence.
So there is no real value there. If the underlying model updates or if OpenAI decides to build your specific feature into their base product, your entire business collapses overnight.
Precisely. Investors and intelligent consumers see right through them. They offer absolutely no defensible proprietary value.
So how does Lulu avoid being a wrapper?
Premium valuations are strictly reserved for platforms that combine underlying AI models with deep proprietary datasets, highly structured methodologies, and measurable user outcomes.
So the AI is just the engine.
Right. The AI is the engine, but the proprietary data is the fuel and the steering wheel.
And that is where Gary Adkins' Real Wealth Blueprint comes in as the steering wheel. This isn't just a loose set of ideas. The documents show a highly structured set of guardrails placed directly onto the Lulu AI.
It's very rigorous.
It operates on a core mathematical equation that dictates every piece of advice it gives.
Right, the formula.
The formula is financial control plus the sum of FSN and FIM equals real wealth. Okay, we need to unpack those acronyms because they are the lifeblood of this system. Let's start with FSN. What is that?
FSN stands for Financial Security Number.
Okay.
It's a very specific, quantifiable target. The platform defines this specifically as having 12 months of liquid cash reserves.
12 months.
Not invested in the market. It's not invested in the market, not tied up in real estate, liquid. It takes your total monthly expenses, multiplies them by 12, and that is your FSN target.
So if my monthly burn rate, mortgage, food, car insurance is $5,000, my FSN is $60,000.
Exactly.
And the AI is structurally mandated to push me toward that specific number before it tells me to do anything risky.
Correct. It builds a concrete foundation first. And once that foundation is built, it shifts focus to the FIN.
Which is the financial independence number. How is that calculated?
The FIN is defined as having passive income streams that exceed 2 times your monthly expenses.
Oh, wow. 2 times.
Yes. So using your example of $5,000 in monthly expenses, your FIN target is $10,000 a month in purely passive income.
Like dividends, rental yields, automated business income.
Exactly.
So the entire architecture of Lulu is constantly driving the user toward these 2 specific mathematical targets. It's not just saying, get richer. It has a literal finish line.
The very clear finish line.
And it achieves this through what the documents call the 6 pillars framework. This is the methodology that prevents the AI from just giving ad hoc, random advice. The AI is constrained by these pillars. Let's walk through these because it shows how surprisingly comprehensive this system is. Pillar 1 is simply titled Thinking.
Right.
Why start there? Why not start with budgeting?
Because behavioral finance dictates that before you touch a spreadsheet, you have to fix how you think about money.
That makes sense.
Pillar 1 is about cognitive restructuring, mindset optimization, and high-level strategic planning. The AI actually assesses your risk tolerance, your relationship with debt, and your long-term vision.
Oh, interesting.
Yeah, because if you have a poverty mindset or an impulsive spending habit, no amount of tactical budgeting is going to save you. The AI addresses the psychology first.
That is fascinating. It actually works like a human coach, assessing your mental state before handing you a financial plan. That leads right into Pillar 2, University. This completely blew my mind reading through the sources. The app isn't just a tool, it has a built-in curriculum of 10 distinct books.
Yes, and I want to emphasize that these aren't just, suggested reading lists or external links to Amazon.
Right.
It is an integrated, proprietary educational system. It includes titles like The Real Wealth Blueprint, The Rules of High-Level Thinking, Section 609 Credit Mastery, and the Living Revocable Trust Master Plan.
So it's real heavy stuff.
It's comprehensive financial literacy baked right into the platform. And the AI actively tracks your progress through this material using interactive quizzes and conversational assessments.
So if you ask the AI to help you set up a holding company, it might say, sure, I can help with that, but I see you haven't completed the module on corporate structures yet. Let's review that first so you understand what you're doing.
Exactly. It forces competence before execution. It's a massive safeguard against users making uninformed decisions.
Pillar 3 moves into the tactical, credit and finance. This is the strategic management of both personal and business credit profiles, fixing errors, optimizing utilization.
Very foundational.
Then Pillar 4 is cash investing. This covers establishing that FSN emergency fund we talked about and executing active, liquid investment strategies.
And then once you have that security, the framework aggressively pivots.
To Pillar 5.
Right, Pillar 5 is cash flow investing. This is the pursuit of the FIN. Identifying, vetting, and securing targeted passive income streams, real estate syndications, dividend portfolios, automated digital businesses.
And finally, Pillar 6, passive assets. This is the really high-level stuff. This involves advanced automation utilizing the infinite banking concept, which is deeply central to the IDC Club's overall philosophy and establishing legacy trusts for generational wealth transfer.
The scope is incredibly robust. It takes a user from absolute beginner psychology all the way to complex trust entity structuring.
It is robust. But I have to play devil's advocate here.
Please do.
I can hear the skeptic listening right now. How is interacting with Lulu across these 6 pillars fundamentally different from me just logging into ChatGPT, pasting in my salary, telling it I want to invest in real estate, and asking it to build me a plan? I mean, I can give a generic AI instructions. Why pay for Lulu?
That is the multi-million-dollar question.
Yeah.
And it's the exact question investors ask during a seed round.
So what's the answer?
The answer lies deep in the technology stack. Lulu is a highly specialized engine. Yes, full disclosure, it utilizes the Google Gemini API as its foundational cognitive base.
Okay.
But it is augmented by over 15 custom-built proprietary financial tools that Gary's team engineered. Lulu doesn't just chat with you. It executes complex functions.
Meaning it reaches outside of the chat window to do actual work.
Precisely. In software development, this is called function calling. And one of the primary technological differentiators that Lulu deploys here is something called document intelligence.
Document intelligence, how does that work?
Let's illustrate this. Say you have a highly complex 40-page PDF of a commercial real estate contract, or a stack of disorganized monthly bank statements, or dense legal documents for trust formation.
A nightmare, basically.
Exactly. In a traditional financial app or a standard AI chat, what do you have to do with those?
You have to sit there on a Sunday afternoon, read the document, and manually type all those numbers and legal names into a spreadsheet or a chat window. It's exhausting.
It is exhausting, and it is the single biggest point of friction in personal finance. Manual data entry is the #1 reason people abandon traditional financial tracking software within the first 30 days.
Oh, I totally believe that.
Lulu eliminates this entirely. You don't type anything. You upload the PDF directly to the platform's blueprint viewer.
So I just drag and drop my bank statement. Then what happens?
The system utilizes advanced OCR optical character recognition and natural language processing to read the document just like a human analyst would.
Wow.
It parses the text, identifies complex financial data like categorized expenses, varied income streams, and asset valuations. It can even detect legal entities, recognizing if a document is establishing an LLC versus an S-corp.
So it actually understands the context of the document.
Exactly. It extracts all this data with high precision and automatically updates your dashboard metrics in real time.
That is massive. It's not taking your word for what your finances look like. It's looking at the original source documents, pulling the objective truth from them, and organizing it. That alone saves hours of work.
Days sometimes.
But there is another feature in the technical documentation that really stood out to me: memory compaction. Can you explain how this works and why it matters?
Memory compaction is where the AI truly crosses the uncanny valley to mimic a high-end human executive director.
Okay, tell me more.
Think about a standard AI chatbot. After a few thousand words, it forgets the beginning of the conversation, right?
Yeah, it starts repeating itself or losing context.
Exactly. Its context window fills up, and it loses the thread. Through advanced conversation, compaction, and recall algorithms, Lulu maintains a persistent, continuous context of your entire financial journey over years.
So it remembers that 3 years ago I told it my risk tolerance was conservative, or that I had a very specific goal to buy a multifamily property in Florida by 2028.
Yes, behind the scenes, it continuously stores your conversation history, extracts the key insights, clusters those insights by topic like real estate goals or tax anxieties, and preserves that context across hundreds of disparate sessions.
That's incredible.
It creates a persistent, long-term relationship. When you log in on a Tuesday, it's not starting from scratch. It knows who you are, what you've achieved, where you've stumbled, and what you're afraid of.
That is the ultimate luxury of a human wealth manager, right? You don't have to re-explain your life story every time you walk into their office. Lulu does that digitally. Okay, having established this massive power, the proprietary methodology, the document intelligence, the long-term memory, we have to transition to how this actually looks in the hands of the end user. Deploying Lulu. Who is this actually for? And how does it tangibly change their financial trajectory?
We can look at this across three distinct user groups.
Let's start with the everyday 9-to-5 worker. The person who wants to be an investor but doesn't really know where to start.
This demographic is where we see the massive democratization of financial services play out. We mentioned earlier that human financial coaches charge anywhere from $200 to $500 an hour.
Right.
If you want a comprehensive plan, you're looking at thousands of dollars up front. That pricing structure completely isolates the middle class. It completely prices out the mass affluent who have some money but not, family office money.
They are totally stuck in the middle. Too wealthy for generic budgeting advice, too poor to hire the mahogany door advisors.
Exactly. But Lulu completely upends that paradigm.
Yeah.